Right, I think we're all here and we're all online. So we will start the meeting. It's just gone 10 o'clock. Welcome. So this is a meeting of the Pension Fund Board as opposed to the committee. The committee meeting happened a couple of weeks ago. So we try and interleave our meetings so that we can be both retrospective of what the committee has decided and a bit prospective as well, so we can perhaps give them things to consider for their next meeting. But we have the benefit of having Simon Coles here as well. So he's the chair of the committee. So he's a good go-between between the two organisations. I always try and attend the committee meetings as well, but I'm normally online when they happen because I live up in Frome. So it's a bit far to come just to attend the meeting. So welcome. The first item on our agenda, I just turn to our agenda, is apologies for absence. I don't think we've got any apologies for absence because I think the whole board's members here. So fantastic. We're quorate, brilliant. And then we've got yes, our declarations of minutes from the previous meeting. So we'll just briefly scan through our minutes from our last meeting. Has anyone noticed anything that they'd like to correct or any questions on our previous meeting? Towards minutes of our meeting, because those are the minutes on. They come after that.
Previous one.
Yeah.
Check what happened. Because
no, remember the last.
We didn't have a quorum.
July, so there'll be the.
Right.
Yeah.
We weren't quorum in July, so they will be the 28th of April ones.
Yes.
Yes. Okay. So our last meeting minutes to consider are the Friday, the 28th of April. So it's, if your memory is that good, we can remember what we discussed last time. So we always review what the previous pension committee meeting has considered. So it's good to have those bullet points there as a reminder of what the committee covered. We always look at the risk register. And we made some minor changes to that, some tweaks to that. We always consider our business plan. And in that meeting, we looked at our review of the funding strategy statement. So that's working its way through the process. It's gone out to consultation, I understand. So I think the committee has now considered the funding strategy statement.
The committee approved it at their meeting for the 15th of September. So it has
Perfect.
now been adopted.
It's been adopted. Great. And we always consider investment performance in our meeting. So if there aren't any corrections or questions about our previous meeting minutes, we'll move on to our next item. Oh, and I need to sign them. I'll do that now, otherwise I shall forget. Thank you very much. So next item on our agenda is declarations of interest. I know we've got a standing item on our declarations for those of you who are members of the local government pension scheme, but any other declarations of interest, Steve?
If I could just seek clarity, because obviously this is a new board compared to the pre-April board. So if I could capture all the declarations now, they'll then become a standing part of the declarations of interest. I think it helps with the audit requirements.
I'm a member of the local government pension scheme.
I'm a member of the Taunton LCN, obviously Somerset Council, obviously. But I'm not a member of the pension fund.
And
I'm a member of the pension fund.
Simon.
I'm a recipient of a pension.
I'm not a member. I am the odd one out. Right, next item on the agenda, we've come a full year, and are there any members of the board who would like to stand as chair? I am prepared to act as your chair for another year. However, according to our, are they standing orders, our regulations, it
Terms
should,
of reference, it's,
terms of reference, it should rotate around the board. And I've
But
been doing
that'll-
it for how many years now?
many,
Many.
no, two.
2 years now. So, please can I ask you to consider, if anyone would like to step in halfway through the year and become our chair, I would welcome that. If anyone else would like to be our chair. In the absence of that, I will continue to chair, but it's sometimes nice to have a go if you'd like to be chair at some point. Please let us know, and I'm sure we can arrange an interim election if that would.
It's always at the behest of the board, basically.
So please consider it. It's quite a nice role. We don't get paid anymore, but
Something
it's
for your
quite,
CV.
it's something for your CV, quite absolutely. So does someone need to propose me? And we need to have an election. Thank you, Rod. And we'll have an election. So you'll have to let me, otherwise, yeah, I can't. Thank you. Right. We'll consider that unanimous. Yes, bit of a farce, but please consider taking on the role of chair next time. So now we have agenda item 5 on our agenda, and that's public question time. And I understand we've got a question for Sigurd. And Sigurd, as you're in the room, would you like to read your question out?
Yes, I'll do that. I think I'm switched on time.
You are.
Yeah, good. I'm very pleased that David Vickers, Chief Investment Officer at Brunel Pension Partnership, is attending the meeting this morning, as my question relates to both organisations. The International Energy Authority has for long been warning about the need to stop extracting fossil fuels now. Last week, the IEA reminded us that the path to limiting global warming to 1.5 degrees C has narrowed further, and that the alternative needs to be clean energy growth. Coupled with the dangers to the environment from continuing to invest in fossil fuels is the added danger from the financial value of these assessments suddenly collapsing, the so-called Minsky moment. This is all the more likely to happen when investment managers follow outdated and over-optimistic climate models that are not in line with what most climate scientists are predicting when it comes to global heating. If such a scenario were to be triggered in relation to the investments in an oil or gas company by Brunel Pension Partnership or Somerset Council's Pension Fund Committee, who would ultimately be responsible for any financial losses incurred? What part does our pension fund board play in examining this possibility? Thank you.
Thank you, Sigurd. And I understand, Anton, you've prepared a response from the board, but after that, I wonder if David, you wouldn't like to mention something after that. So Anton, if you'd like to answer on our behalf.
And as usual, Sigurd, I will email this straight away to you afterwards. There is a financial risk in every investment the fund makes. If the investments collectively produce lower returns than anticipated, then ultimately any shortfall is made up by fund employers through additional contributions. These risks are covered on the risk register. For the second part of your question, in the written response, I've actually just copied a part of the terms of reference for the board. I'm going to précis how I read that rather than read, because it's set out with A's and B's and stuff. So, but I will précis it for you briefly. The regulations state that the role of the board is to assist the administrating authority to secure compliance with the LGPS regulations, any other legislation relating to the governance administration of the LGPS, and the requirements imposed by the pensions regulator in relation to the LGPS. It's also to ensure the effective and efficient governance and administration of the LGPS. To do this, the board will assist the administrating authority by making recommendations about compliance, process, and governance. The board does not have a decision-making role with regard to strategy or policy and can only challenge decisions made by the committee where the board considers a decision to be in breach of the relevant regulations. The board's role is to have oversight of the governance process for making decisions and agreeing policy. And for those of you in the chat, I might add it to the chat if I can work out how to add a document, because it's, as I say, it's rather a big amount of text to just put in as free text.
So in that response, that formal response from the board, Sigurd, at the end of that, we do consider all investments, but particularly ESG investments. One item in our risk register specifically relates to performance and performance of anything that's climate related within that ESG, and I would consider performance part of that being a drastic loss in value because in other non-ESG, if you like, investments because of climate change. So it is considered, and I wonder if David, you want to add anything to what the board have said?
Yeah, absolutely. And forgive me if I'm teaching anyone's grandmother to suck eggs, so to speak, because I've not met you before, so I don't know who knows what about Brunel. But Brunel, from its very inception, as Anton, I'm sure, could tell you, has had ESG embedded in everything we've done. Before it was popular, before it was commercial, it was just the way that the framework of Brunel was set up, not least because the Environment Agency, one of our 10 founding clients. So all of the managers we have selected embed ESG considerations into their stock selection at every single level. I think the other thing to note is we have a responsible investment policy and a climate policy that also aligns very aggressively towards net zero. We have signed a pledge to hit net zero. Faith Ward, my Chief Responsible Officer, is also the chair of the IIGCC, which is the Intergovernment Panel on Climate Change. I sit on the PRI, on GFANS. It is something we take super seriously, and it is embedded in every single stock we buy. It is also fair to say, I would absolutely agree with you that climate scenario modelling as it stands today is woefully inadequate. It doesn't take into account, in my opinion, the tipping points that magnify and the waterfall kind of effect. What I would agree with is, I think, as you said, Councillor Hills, that sadly that type of scenario modelling is not limited to what happens to the energy stocks you own. Actually, it's probably more detrimental to the property stocks you might own and other things, depending on where you're based in the world. So climate scenario modelling is woefully inadequate across the entirety of the financial regime, not just in energy price stocks. It might give you some, hopefully some, however, some warmer feelings in that because of our responsible investment policy, because of our net zero pledge, and indeed yours, you are very underweight those type of names that I think would probably be would cause you more concerns. Indeed, I think you've switched to the Paris aligned benchmarks. Looking down your portfolio, we have very, very low amounts in those type of stocks anyway, and they are decreasing. And we measure what's called our weighted average carbon exposure. We measure our reserves, and they are all on a declining path as set out by our pledges in net zero. So it's something we take super seriously.
Thank you, David. That's really helpful. And thank you, Sigurd, for your question. Are there any more questions that we've had any notice of from many members of the public? Okay, so we're now going to move on to our next agenda item, which is a question and answer session for David. So thank you so much for coming today, David. It's really helpful. And I know I've got some burning questions for you that I hope you've had prior awareness of, because they're things that are weighing on my mind, I suppose, as we move through the process of our next round of updating our investment strategy.
Yep.
And one of my major concerns is how we go about assessing risk, and the information that we have easy access to in order to carry out that process. I'll read out the question that I've sent to David already. I would like to find out more about how Brunel and its selected investment managers go about assessing investment risk, particularly volatility and capacity for loss. The information in the quarterly reports considered by the Brunel Oversight Board give a single word descriptor for investment risk, high, moderate or low, for each of Brunel's portfolios. This does not give sufficient granularity to properly compare the portfolios. As part of the process of updating Somerset's investment strategy policy, I would like to carry out an analysis of investment risk, volatility as measured by standard deviation, and maximum drawdown as a measure of downside risk. In relation to returns received, the fees charged, and the carbon intensity for each of the portfolios available to us from Brunel. Benchmarks can act as a proxy for risk and return measures where necessary, because I'm aware some portfolios haven't been invested in for a great period of time. And I'd also like to add to that, if you don't mind, is really getting an understanding of how the other boards within Brunel deal with this issue. What other questions are you getting from the other boards when they come to update their investment strategy? So if that's not too much, and I know you've had prior knowledge because that's a big long question, but I wonder if you can give me any answer to that, David. That would be great.
No, of course, I should do my best. I think it's worth, I think because this is the first time I would have spoken to many of you kind of personally, if I just spend 1 minute telling you who I am and establishing hopefully some credibility, otherwise you might as well ignore me. So I'm the Chief Investment Officer of Brunel, as someone rightly pointed out. I've been here for 3 years now. Prior to that, I was the head of the multi-asset team at Russell Investments, managing or had oversight for about £80 billion worth of pension fund assets and sovereign wealth funds, and personally responsible for managing around 30 billion. Prior to that, I used to run big endowments, so charities by one of a different world. So I've been doing this multi-asset work for the best part, I know I look very young, but for the best part of 25 years now. And so I have some degree, hopefully, of experience. And I think the crux of your question, for me at least, is when you're looking at doing what I suspect what you're talking about is at your triennial valuation point, how do you set your strategic asset allocation? How do you build these things in? My mind is always firmly ensconced that there needs to be a very big dollop of pragmatism. You know, what one learns in business school or wherever one learns financial accounting, and then what happens in the real world are very, very different things, sadly. Not sadly, but it provides a framework. So where I see one of the reasons we don't provide that information is because you are opted up as an institutional investor. You know, you run a big pot of money, you're professional in your day jobs, and you know, this isn't small beer we're talking about. So in opting you up from retail, who get this type of information, because one has to protect people who, without being rude, perhaps aren't as financially literate as I suspect your pension committee are, you have to tell them that if you're buying an equity fund, it might look like this. If you're an institutional investor, there is no such requirement to do that. Because I suspect, and I don't know the inner workings of your board, but there'll be people on your pension committee, on your board, certainly Anton and your advisors, that should be imparting that information to you. I say should. You don't. My other view is that actually, for yourself, who is a long-term, open-ended scheme, volatility isn't really relevant, I have to say. Volatility for me is just a measure of how things go up and down, not down. You know, what people really care about is, are you ever going to lose money? You lose money not just when investments go down, but when they go down, you crystallize that loss. Because you're open-ended in nature, you should be able to ride through those hills or peaks and troughs, sadly, more troughs recently, than many other claims. If you're a closed-ended scheme, you have a 10-year plan. You can't lose money just before. Like if you're retiring at 65, the worst thing in the world is to lose money at 64. You're open-ended, your liabilities probably go at 100 years, I'm assuming. So I would suspect when you do your asset allocation triennial valuation, it's at that stage you can have a think about what volatility might be, what drawdown might be, although that's again a little less relevant unless you're cash flow negative and going to crystallize any of those losses. It's probably more important to look at correlation. It's very important to look at a total portfolio level. And this is the one thing I was drummed into me very early on. As opposed to looking at the individual building blocks of your portfolio, you should look at the totality. That's what you should care about. You can afford a very high risk proportion of your fund if it fits your objectives, if there are other things that kind of counterbalance that. The things I would say rather negatively about measuring slavishly volatility and standard deviation, and even VAR, which is what the pension regulator will often have you do, is it is often measures the best of the worst outcomes. What you really want to know is the worst of the worst outcomes. And any forecast that I've ever seen will talk about a return expectation for equities of 7 and a volatility of around 15, 16. That is an average over the last number of years. What you actually care about is when it goes wrong, how bad does it go? And as you know, volatility gets to 80. Markets fall 40, 50%. That is out the range of normal forecasting. So any kind of volatility and standard deviation measure is only a really, really rough guide. And then risk, as I would think about it for you guys, and then, this isn't me giving you advice because I don't know the ins and outs of your portfolio, of your scheme. You can have liquidity risk. You can have shortfall risk, i.e. the risk of not meeting your liabilities. That can come through your interest rate sensitivity. It can come through your asset profile. It doesn't really get measured in volatility, I have to say. So we don't, well, as you know, we do in our quarterly evaluation show the post volatility of the funds. I think that's useful once they hit the 3-year period, because over 3 years that you start to get the right amount of data points for it to make any sense. Prior to that, there's not enough mathematically for it to be worth the paper it's written on. When one thinks about asset or the portfolios you own more broadly, it's always worth thinking about it in two senses. The beta, so the benchmark risk. So you're in equities. So let's just think about MSCI equities, not the portfolio. And then what we measure around that is the active risk we're taking vis-a-vis that benchmark, the tracking error, the active risk. You've got a benchmark that hopefully goes up in a straight line, but the volatility that we measure here, the active tracking error is kind of the icing on the bigger cake. The cake is how much you have in equities, not really the type of equities you have. You are absolutely right. The document as it stands today has a very simplistic guide, kind of a 1 to 10. There is a fairly significant-ish document behind that details what that 1 to 10 means in terms of volatility, in terms of other risks. And it's really just to give you a guide.
Hang on a minute, David. I don't think I've seen the 1 to 10. Is that in the descriptor underneath for each portfolio? All I've focused on, and it may well be there, I've just not read it, is in the box at the beginning of each portfolio descriptor is high, medium, low. And I'm aware that we're in a public meeting and that document itself is confidential. So I don't want to give too much information, but all I've focused on is high for all equities other than the diversifying returns.
Yes.
Moderate for bonds,
yeah,
and low for gilts.
Yeah, so you're right. The classification goes from low to very high. There is a secondary document that also talks about liquidity risk, which is numbered as opposed to, and I think it's in the document. I think you may have seen sight of it's in the portfolio specifications document. Okay. So what happens, and this is okay for public, I suspect. At the beginning, we serve at your pleasure, as a chief of police would say to the mayor. We create funds that we design together. So the clients consensually say, we would like this fund, an equity fund, a world equity fund, and we would like this type of return target. We then go about building that out.
Please, could we have a low risk, high return, low wacky fund tomorrow?
Do you know what? If we build one, I'm going to be the first investor. I can tell you that off the bat.
And I'll just interject there that, this shouldn't be seen as, I know David will say it's at our pleasure, but it shouldn't be seen as we as Somerset can invent something that we as Somerset want and no one else wants. Because in the context of pooling, we need to all want, or a good portion of us want it, otherwise it isn't financially viable. It just becomes too costly, and it becomes costly in Brunel time as well as the explicit costs. So there is a pressure on all of the clients collectively to keep the number of portfolios requested to a manageable level. And we have a process, it's a written process we must go through to add or amend or delete a portfolio. And so it needs to be agreed consensually, and it needs to have a reasonable weight of support. So if we ask for it and no one else wants it, the answer should be no.
Yeah, and one change that we've had recently, and I think I can mention it, I don't think, stop me if it was in private session. But one change was the idea of changing rather than from the FTSE 100 to the FTSE 250. And that immediately lowers the carbon intensity of that portfolio because we've not got Glencore and various other extractives at the top. Is that right, David? That's one way that we can.
Potentially, yes. All I would say about you have to be very careful with it. So WACC is weighted average carbon intensity. Firstly, there's what they say, lies, damn lies, and then statistics. So actually a small company with big revenues can make your WACC look a lot higher. You can get certain companies that look worse than a major oil company because of the way that calculation. The second thing to note around WACC, so we measure WACC, we measure reserves, we measure emissions, we measure, actually more importantly, alignment, because there are lots of, to put a very blunt kind of statement out there, I can decarbonize your portfolio tomorrow. That will not change the world. What you do when you sign up to net zero is use your portfolio as a weapon, as a tool, as a means to change the real world economy. So actually, we have a sustainable fund that you're not invested in, that is, one would consider a little greener if one wants to think about it in those terms, and the ones you have, it has a higher WACC than your other portfolios because it's invested a lot in old industrial companies that are kind of the old, not energy companies, but the old and dirty companies that have really high WACCs, but have a determined and credible plan to change, to go through the transition. So actually you want to take those dirty old companies and pull them through the transition. So WACC is only one of the metrics we use. Actually, alignment is much more important to us, as in, are you going to get to net zero? Is it credible? How quickly? By how long? So I would just caveat, we internally look at about 5 or 6 different metrics and then have a narrative around alignment, which is more important than just WACC, actually. So you can get very, very green portfolios that have made all the right pledges, that have lower WACCs than some traditional portfolios.
So the fund you've just mentioned, is that sustainable?
It's called the Sustainable Equity Fund. So that has a dual mandate of obviously beating the benchmark, but also in investing in companies in the listed space, investing in companies that have a degree of impact in a kind of a societal or climate way. So it goes one step further than just having ESG, which is embedding the risks. It seeks out companies that have a certain profile in certain regions. So it goes a little further, but it has a constricted universe because of that, and so it has more active risk embedded within it. But it has a higher WACC, and I think that's very important to note.
Yeah.
It looks optically it looks worse, but it's a fund that's moving further in the direction you're talking about.
Thanks very much. And
as well as WACC, there are 2 other measures that are in the quarterly report that I provide to you, and I think all 3 measures are in the annual outturn report that goes on the Brunel website and is public.
And that's one about extractives, isn't it? And I can't remember off the top of my head. I can't remember the third.
It's how much is coming out the ground, how much is already in the ground, and what your intensity is, as well as alignment metrics. So if you have some time, the outcomes report we publish annually, it's a bit of a big document, but it really goes to show you and talk about the different narratives, what we're doing, how we're doing, and what the impact is you're having with your cash.
Brilliant. And I'm aware I jumped in, David. So did I cut you off on what you were saying in answer to my question, or can we go to other board members' questions?
I think if you were happy with my answers, I think probably we could move on.
Very happy. Thank you, David. That was really good, really reassuring. Simon, you have a question. Oh, okay. I'll open it up to the other people in the room. Ant.
So just thinking about what Anton was saying. So in terms of getting consensus for funds and that kind of stuff, what is the mechanism for sort of triggering that process? So is it you get 1 free request a year, or do you have to you get so many points? How do we go about doing that?
No, so there is no restrictions on it. So if a fund wanted to put in 15 CAD requests a year, I think the rest of us would get slightly irritated by it, but that would be fine. There are no restrictions on it. The reality is actually a lot saner, because we worked very hard as a group when we set up to come up with a broad set of portfolios that should meet everyone's requirements within reason. That gave us a solid base. I'm trying to think, and I probably got more experience than you, David, how
Yeah.
many formal CAD requests we've had.
What does CAD stand for?
Creation, amendment and deletion.
Okay.
I can think of two or three in my 3 years here. I think Anton's absolutely spot on. You only today own a subset of what is available, because that is how you built your portfolios. We have, if I think about the ingredients in the cupboard, we have got most of them. What we haven't got is the variety of spicy flavors. We've just got global equities, UK equities, emerging market equities, private debt, private equity, private credit, infrastructure, renewables. There's a whole, we cover most of the bases, and so actually they were wanted by all of the partners, or the majority of the partners. So most things are there. The most recent CAD requests have come where somebody, Cornwall, have wanted a kind of a local bespoke impact fund that's local to Cornwall. So that's the more recent one that's gone through. And I think there was the last one I was involved with was, which you own actually, is the passive funds, the passive index funds, to allow you to access cheap beta, but that is Paris aligned as opposed to non-Paris aligned.
And if I cover just those, my recollection is the Cornwall one eventually was effectively, I think the CAD technically was withdrawn because Cornwall agreed to do it as a elective service.
That's right.
So within the Brunel world, there are the things that Brunel offer to all of us, and it's in the price, as it were.
Yeah.
And then we can all request stuff that if no one else wants it, Brunel will go, well, we can provide this, but you have to pay for this as a standalone service. With the passive ones, I can't remember how we did that as a CAD. I'm not sure that wasn't just a sort of, some people said they wanted it and you went away and researched it and created something, because it wasn't, I don't think we actually had a CAD. I think it was sort of consensual. And also within the passive space, it is possible for you to add flavors without it adding to the cost, really. So we do have more flavors within passive than in other areas. And the UK one is as not yet a formal CAD request, I don't think. Oxfordshire raised it. We are all discussing it. I think where we're going with that probably is that we'll have all agreed it before the CAD turns up, and so then the CAD will get nodded through.
Yeah. Any other questions? Yep, Simon.
Thank you. Just for clarification, if we decide that we want to add a different flavour to this, that can be worked through, and there would be the caveat that our professional advisors would say, actually, we don't think that's a very good idea for the fund. And also the other members of Brunel would say, actually, we do not agree with this. You are an outlier, you're on your own. So you have the opportunity to do it on your own, as Cornwall did, or we're going to block it because there's 8 of us don't want to do it. There's only 2 of you that do.
And I would always advise that when we start that conversation next year around refreshing the investment strategy statement, the starting point is here are the Brunel portfolios.
Yes.
And please choose from those.
I mean,
because my professional advice would be, actually, they should meet anything we would want.
And the whole point behind having the spread is to spread the risk, to ensure that we are able to maintain paying all our members their pensions as they come due. So,
and actually,
I don't like going off wildly saying I only want to invest in solar panels.
And one of the things that's an oddity of the investment regs for the LGPS is the only thing they do require is that, one, you take proper advice, fair enough. But then the only other thing required is that you produce a diversified portfolio. That's the only thing it specifically mentions. Now, whether that's just because they're a bit old now and they need refreshing is a moot point, but that's the only requirement they put on us. And I would suggest that the Brunel portfolios, as they stand, deliver that without any problems.
I would also suggest that the whole point behind using Brunel is to have that diversification to protect the investments that we have, rather than going off on a whatever is flavour of the month this month.
And it's fair to say
And
that
the professional advice would be that.
Whether you agree with pooling or not, whether pooling has achieved what it set out, that is the rules now. The government said thou shalt do it.
Yeah.
Before pooling, we created our own portfolios, so we could have them tweaked to our own personal preferences. But the reality is that many of them didn't look that different to what Brunel's created. So our UK equity portfolio before basically had the same target and the same benchmark that the Brunel one currently has. The emerging market one we had before had the same target and the same benchmark. So a lot of them are very similar, and actually we're not stepping outside what we want, because Brunel actually delivers exactly what we want.
Notwithstanding all that you've said, key here is that we get a regular look at what we want to see our investments in and how much diversification we are prepared to entertain, depending on what the circumstances are. When we look at this annually.
3 years. Really.
The investment strategy statement is where it is formally sort of declared. That is the mechanism that the regulations encourage. The regulations state that it should be reviewed every 3 years. On the last cycle, we went slightly longer than 3 years because we were 2/3 of the way through our transition of assets to Brunel, and it made sense to get over that hurdle before we re-looked at it. This time, 3 years would be March 2025, which is why we will, as a board committee, together, first informally and then formally, we'll start it in sort of the spring, and then we'll sort of work through it through next year. Formal paper will come eventually before board at their probably the January meeting next year, and then committee for formal approval at the March 25 meeting. That is the plan.
So, David, I'm just going to come back on the very last bit of my question, which was the add-on bit, which is how do the other boards deal with these issues? So if you could share some of the other boards, and we can stand on the shoulders of giants and do what they do.
I mean, yes, of course. So very clearly, actually, my mandate at the minute does not stray into asset allocation. That's the kind of, that's still, not still, but it is the, resides with Anton and yourselves. What Anton will know, because I often do stray over that gap slightly, is I will often provide my thoughts and my advice and say you should advise you ask your advisors this or that, given the market conditions. As I understand, so I'm not present in every meeting, but I am present in some. And from my previous life, what I know to happen is that when you come around your training evaluation, you'll look at your, you'll get your actuarial feedback. So what is the return target you perhaps need? You'll get your return forecasts. So what are we forecasting from the various assets we own? Does that meet what we need? Yes or no? How does the correlation work? What are the diversification benefits? But it's really done, I think, between your client officer, so Anton and his team, and then whoever sits with you in the advisory chair, and then I guess ratified by the board on the basis that the good work has been done. So Brunel do not really are not involved in that process, bar sometimes I just provide around the edges my own thoughts from the experience I have. So it sounds very much like you're doing what everyone else does, to be completely honest.
Fantastic. That's good reassurance. Simon.
Thank you, Chair. So if one believes the government's statement recently that they will halve inflation by the end of the year, in the 3-year target that we look at, where do we put the inflation of the last 18 months, 2 years? relation to that, and how does that affect how we might look at altering the diversification of some of our funds? Because inflation has made a major difference to a great number of things, not least of which our own funds.
I'll start, and then I'll probably bring David in to talk about sort of inflation generally and impact on investments. Explicitly within the actuary's calculations for us is a inflation forecast. But that inflation forecast is to the average cash flow point of the liabilities, often referred to as the duration. And for us, that's, I think it's around 21 years. So the actuary is saying, when I make my inflation forecast, I'm actually interested in what I think inflation is going to be over 20 years, not 2 years. The other thing is that the actuary then clearly states how they calculate that, because they don't actually make a judgment as such. What they do is they look at two types of government bonds. The government issues bonds that are what is known as nominal, so they just produce pay a capital amount back and a interest payment semi-annually, I think. And they also have inflation-linked bonds, where both the interest payments semi-annually and the return of capital at the end are linked to inflation explicitly. And so they look at the 20-year bit and say, what's the difference between those two bonds? Because that's what the market is saying inflation will be over the next 20 years. And that's how they come to their inflation number. In my view, the most important thing about inflation is it's that impact over the long term. And ultimately, because we have liabilities beyond 50 years, which is the longest government index-linked bond you need something that doesn't have an explicit inflation adjustment to it, but historically has tended to outperform inflation. And that tends to be equities. But and David will probably pick up some sort of more recent, more sort of immediate sort of economic ideas around inflation, but he may comment on the long term as well.
No, I mean, I'll try not to comment too much on the long term. And almost to my comments of volatility, there's a lovely expression that forecasters are like one-eyed javelin throwers. Interesting to watch, but very inaccurate. And so whoever's polishing the crystal ball 20 years out is going to be wrong. I think that is a given, an absolute given. What I used to try and do, and Anton is absolutely correct, I think, without trying to be patronising, is what you want to do is align your portfolio. If you have inflation-linked liabilities, align your portfolio so you have as much inflation pass-through as you can within the confines of diversification, within the workings of portfolio construction, and it looks to me, quite frankly, like you have it. To the question that was asked, every portfolio, every asset class has been revalued. So if we wind the clock back to when interest rates were zero, interest rates have gone up because inflation has gone up. That's the linkage. Always has been, always will be, I suspect. If you could get 5% in property because you could only get 0% in your bank, well, that 5%, that risk premium, that extra 5% seems okay. Suddenly, if you can get 4% in your bank and 5% in property, well, that is not okay. That 1% is not attractive enough. So in order to re-establish that risk premium, what happens is prices fall to increase your forward-looking return. And that is exactly what happened in 2020. Bond markets, as you know, fell precipitously. Index-linked bonds fell some 30–40%. Equity markets, hedged fell about 20%. Everything came down to revalue to the world we now exist in. My personal opinion on long-term inflation is, whilst I certainly wouldn't want to put a number on it, is that I think it's going to be higher more persistently than it has been. The world has changed. The things that really drive inflation, it's not Ukraine. That's the spark that lights the tinder. The things that drive inflation over the long term are, or have driven it down, globalization. Well, that's rather run its course. There isn't another China to add to the WTO. There isn't another Berlin Wall to come down. you know, we have the amount of workers we've got, and actually those numbers of growth is declining because demographics is moving against us. So you've got globalization moving slightly in the wrong way. You've got demographics moving in the wrong way, which means your savings ratios are changing. Against that, you've got technology. Technology is usually a deflationary pulse. That said, it's a constant. So actually, I think inflation from here on out is more likely to be higher than we've seen it for the last 20 years, which is again why perhaps you want more money in your inflation, not protection bucket, but those asset classes that can have some inflation tendencies. Bonds have been a terrific investment. Apart from the last 3 years, for about 20 years prior to that, you had a 30-year bull market in bonds where you could just sit back and earn 6% a year with no risk. That world is gone. And I think so the way you're positioned is probably a reasonable one for the world you're looking through. Equities have passed through technically. You know, the goods in the shops go up as inflation goes up. Sometimes a lag and a lead, some more than others. And so actually equities over the longer term have a bit more inflation linkage to them. Likewise, property, private equity, real assets, if you will. It's the bond markets that are nominal, particularly government bond markets and corporate credit, they will only ever give you a certain return because they're going to give you 100p back on your pound if they don't default. And so that is a more nominal, a nominal instrument, which if inflation continues to surprise on the upside, will continue to perform slightly poorly.
And climate change, if we add that into the mix, what
climate
impact
change
is
is
that going to have?
climate change is the transition, the economic transition that we're trying to go through is the biggest one since the industrialization, arguably bigger, because the world is a bigger place than it was 100 years ago. More people consuming. That is an inflationary pulse. There is no doubt about it. It's why, rightly or wrongly, whatever Rishi's doing, he's suggesting at least that he's putting in a new, and I've got a heat pump. It is an expensive proposition. Transitioning away from oil to something else, building out that infrastructure, building out that charging station network is an expensive proposition. You're moving from something to another thing. There's costs involved. So again, climate change or the transition at least is an inflationary pulse. Now, it depends on how doomsday you want to get around climate change. If you think to the worst scenarios, then that is demand destructive. So temporarily, if one wants to call it temporarily, the world looks very, very different when you get to the point of mass migration to parts of the world being underwater, etc., etc. That is huge demand destruction. I don't actually know what the consequences economically over the long term are of something of that nature.
Oh, on that gloomy note,
Yeah.
and
So just one.
raise the mood.
So I personally, I don't see my role as being sort of challenging what our investment decisions are, but more challenging on how you guys make sure you're fit to make those decisions.
Yeah.
Are you guys looking at things like artificial intelligence and that kind of stuff to sort of improve predictability, to find the next hot trend, and almost, I suppose, avoid this collective thought problem that we have where everybody says these things are complete black swan events, but actually it's because we're thinking about the problems the same way collectively across the industry. So I just wonder what is Brunel doing to sort of keep itself relevant and avoid that collective thought down?
I mean, if I think about our governance structure, so ultimately we outsource the investments to investment managers. I used to be one of them. So people like myself end up with the pots of money. They should be always thinking about trends in the market, how the world is moving, what's driving prices, etc., etc. AI being one of those. And AI is an interesting one. You can, again, but like climate change, you can draw some very positive and some very negative conclusions from what's going on. There will be winners and losers. If you think about the internet, and AI is in a similar vein to that to a certain extent. It changed the way everything worked. There were some absolute losers from the internet, and we're still seeing it. High street shops are on a multi-year declining trend. Amazon is on a multi-decade uptrend. The way in which we shop and conduct ourselves, and Zoom, that regards one of the reasons if I can to save my carbon footprint, one uses Zoom, but amongst others, more productive. And so you want to make sure that when you're investing with an investment manager, they are thinking about these things. So the investment managers themselves are charged with thinking about the trends and how they impact companies. Our role at Brunel to oversee them is to ensure that they are. And so we provide, like you do to me to a certain extent, another layer of challenge, of debate. And have you thought about that? What I will often do is take someone who has a view of this, someone who has a view on this, and put them together and say, okay, well, you're telling me this is positive, you're telling me this is negative. You need to explain why they're wrong. And
Right.
yes, and oddly, the investment markets are, I think everyone thinks they're very scientific. They're not. You can have a great process, great people, and you still need a reasonably good dollop of luck. I mean, that's the untold explanation in investment markets, because you're looking into the future, whether it's 20 years in the future or next year. You don't know who's going to be elected. You don't know what Trump may or may not do. You don't know how the Ukrainian war is going to pan out, etc., etc. And so you are always dealing with imperfect information. What you're trying to do is that people have embedded the risks that they know about into the process, because those risks may not manifest themselves, but you still should try and avoid them. If I run across the road 100 times with my eyes shut and I don't get killed, it doesn't mean I was sensible. It means that risk just missed me by luck, not judgment. So you're always making sure that the investment manager is thinking about the other things. And my internal team will look across the whole piece of things that are happening and take it to the investment manager and say, look, you're positioned this way for this type of future. What happens if that future doesn't evolve like that? What happens if, and one of our managers that you own, Bailey Gifford, is very much on the front foot in terms of growth. And they are very embedded and have been for a very long time in AI. They own NVIDIA, which is a stock you probably kind of missed. It was up some 300% this year. They are on that front foot. We've got others that would say NVIDIA is far too expensive. That is pricing in far too much good news. And you just put those two together to make sure you've got the relevant, robust challenge. But you have to leave the investment manager ultimately as the experts and whose day job is to get on with doing what they should be doing. We just provide the governance, the challenge, and the transparency back to you in order to show that it's working in the right way. And to be fair, it has helped that I've been in their seat, so I can go to them and say, well, here's what I'm seeing, here's what I'm hearing, and I know how it works and the thought process, so I can, have a slightly more intimate conversation, debate with them.
And often with fund managers, the discussion is, that's not worked. Why isn't it not worked? And are you doubling down on that decision, or are you deciding actually that this one is one you should just let go? And actually the best fund managers are the ones that correctly get that decision right on both sides, because sometimes there's a temptation to either be over loyal to a stock that has done well for you, or to cut it too soon. And it's those points that tend to be quite important.
That's why I'm sorry.
I think that's why I was perhaps looking for reassurance in things like maximum drawdown, so that when we see performance information for individual portfolios within our whole fund, is to say, well, look, this has happened before. There's been 5 years, 9 months of drawdown on this particular fund. So we shouldn't be too worried yet. And it's trying to build in that when we look at the performance information, we're right to just hold on. It's okay at the moment. And I think that's what we as a board and probably as a committee need is the reassurance that this is okay. Just hold on. It's okay.
So to put a really kind of blunt answer on one of the questions, which might get you over some of the hurdle, in equities, the largest drawdown on record is something like 58%. Now, individual stocks, Amazon, believe it or not, has been down 90% on 3 occasions in its lifetime. So we will always talk to the stock specifics because that's what we're in tune with. The ones that I think it probably is more useful to think about maximum drawdown, because they're not benchmark. So if you have a position in the multi-asset credit fund, its benchmark, for what it's worth, its target is cash plus 4. It doesn't have an equity benchmark or a bond benchmark. So that one is worth thinking about. Okay, what is the maximum drawdown we've seen there? Because it invests in a range of things, not just one. And so we can certainly provide you with some metrics around how these funds have performed in the past, but everything else is benchmark orientated. So equities have been down in the GFC, north of 50% in some regions. Some growth portfolios have been down even further, closer to 60, 70, and some managers even further. So the manager bit, we would always talk through what's been their experience. At a headline level, I think that's probably for the committee and the advice. Say, well, equities on aggregate have had these periods of being down 50%. That's very easy just to draw a chart to give you someone. It's less of a fun thing and more of an asset class conversation, that one.
Yeah.
But the thing I would draw you back to is that those volatility statistics and maximum drawdowns look at discrete and small periods. Our holding period is somewhere between 10 years and infinity.
Yeah, yeah,
And so volatility on 10-year returns as opposed to daily returns,
yes,
even if you work it out on a daily moving 10-year block,
yes.
actually the volatility on that is really, really small.
yes. And I
And
suppose,
that's probably more relevant to us as a
Yes.
risk than
yes.
maximum drawdown or daily volatility.
Yes, and I suppose that brings me back to investment manager selectors, and how do you go about choosing good investment managers, because they go off the boil, and when do you decide to make the switch?
Yeah, sure. I think so. There's a horrible statistic out there, and I'm going to probably misquote it, but it's something like equity markets prior to the recent drawdown in the US gave you 9%. The average active manager after cost gave you 8% or something of that nature. The average investor return was 4%. And that's because people are chopping and changing at the wrong point. We are all human, investors, professional or not, want to buy at the top. They don't want to buy at the top, but they buy at the top and they sell at the bottom. So because, I mean, you're an ideal partner and client because you are very long-term time horizons. Anton just talked about. You can talk about decades as opposed to years. I know we report quarterly, etc., etc. The industry is far too myopic. It creates these bad incentives and behaviors. We have invested in fund managers who we believe have a good long-term track record, who have a strong process that will see them through. But we are very clear that I've never met any manager who outperforms in every scenario all the time. If you're right 6 out of 10 times, you often beat your benchmark. And so that might mean the first 4 years out the gate, you do very badly, because that's the way that the probability might land. So the way we think about it is we hopefully, and this is obviously an art as well as a science, we have invested in good managers that have demonstrated over a long time that they can outperform. We combine managers in such a way that as much as we're able to, we're not always focused in just in those who have the AI stocks, for example, because that would be you're betting on a particular one outcome. So we will have managers that will outperform, and it's a silly thing to say, but I might be happy with their outperformance because they're doing what I would expect them to do in this environment, but the other managers are pulling them through to make the portfolio return a little higher. So in the Global High Alpha Fund, we have where we are able to, we have a value manager that performs very differently and at different times than Baillie Gifford, which is a growth manager. And so a bit like when you kind of, I've got into gardening recently, so forgive me, but you want things in your garden to bloom at different times. You don't want everything to bloom and die at the same time, because that is a real problem. So you create diversification within the portfolios as much as you do at the top level. And then the long-term time horizon we have, and hopefully you extend to us, means that if one of our managers goes off the boil, and they inevitably will, because you're looking into the future, as long as we're comfortable that it is understandable, that nothing has gone wrong with the process, and they're still sticking to the process that we believe in, then we are okay to wear that through. Now, occasionally, or more than occasionally perhaps, it is a subjective view. I've had four different employers in my time, and I suspect people may have followed me or left me at different points. So if a team changes, that's important to us. If a process changes to us, that's important. If we think the world is going to be a very different place from the last 20 years where they have built up a very good track record, that's important to us. But managers do come off and on the boil, and you just want those who are, there's a quote someone taught me very early on in my career, which just stood me in reasonably good stead. If you are second quartile, as in if you're over the average over most time periods, you'll end up near the top. So actually kind of steady as she goes, catches the whatever.
Yeah.
And so I don't need always top performance. What I need
Pension
is steady.
should be boring. Yes.
Yes, slightly, because you've got you can ride through the fads and the trends, and that's what we try and instill in the way my team selects managers on your behalf. I would also say it's also governed by Anton. Anton and his team see everything we do and why we do it and how we do it. So they get a lot of information that hopefully gives a second level of comfort.
And one of the things that is slightly artificial about Brunel at the moment is everything started no more than 5 years ago.
Yes.
And usually you give fund managers 3 to 5
Yes.
years before unless they do something egregious.
Yes.
Yeah.
Prefer to give them that time horizon to prove their worth. And so we had a slightly artificial that we started everything from scratch, and we've tried to be patient with everyone. And I think now is probably the first time where those conversations are getting a little tight with maybe 2 managers across 30.
That
Yeah,
we won't
makes sense.
mention, but
Mhm.
yes, yeah. You know, when it
Yeah,
it's
and we
yeah.
wouldn't necessarily, because obviously, like with the Global High Alpha, that one has 5 different managers. Well, if one of those is off the boil and one of those needs replacing, it doesn't necessarily impact the overall very much. With some of the other portfolios, there's only 1 or 2 managers,
Yeah.
and so it's more pertinent. I always think it's a good discipline to sort of say, what's our biggest problem? Let's solve our biggest problem rather than try and solve lots of
Yeah.
problems.
Yeah.
And maybe some of those other problems will go away.
Yeah.
But also realistically, if Brunel identified 6 managers that they weren't happy with, I think you'd struggle to resource doing 6 searches all at once or replacing 6 managers all at once. I appreciate they also keep what they refer to as a bench. So they did the exercise 3 years ago, and they keep some managers sort of warm, and just we'll keep an eye on that one because we liked them 3 years ago, and we'll. So those are the things that are going on. And we as funds do have meetings with Brunel where we go, why aren't you sacking that one? Or not, probably not quite that blunt yet, but we're more concerned about this one. And
Yeah.
David will say, yes, we are too. And
Yeah.
this is the conversations we've had with them.
Yeah, so there's a great deal of governance. So, I mean, to be fair, as CIO, I don't, I oversee, I don't do the doing anymore. You know, far too grand for all that kind of business. Someone else does it. Someone else does the clever
Just
work.
take all the glory, David.
Well,
Yeah.
usually the other way around, actually. So I have a team that select the managers, and then I have a head of listed markets, and then I have myself. It then goes into the board, and we have something called the IAG, which is an operational group staffed with very senior investors who have now retired but sit on that as non-execs. We are overseen by what's called an ACD also, so an authorized corporate directorate, as you're probably aware, that makes sure we're doing all the right things, following the process. Then it comes, well, not then, but simultaneously it comes to the client group, and it also flows into the BOB, the Brunel Oversight Board. So there's an awful lot of governance, as you can imagine, which makes sure there's plenty of challenge and questioning.
And in that context, Brunel are probably inflicted with more challenge on their decisions than the average.
I think that's fair.
Well, thank you so much for coming today, David.
No,
It's
very nice to meet you
it's
all.
been really, really useful, and on my part, really reassuring. That I think we're doing the right thing, and I think you're doing the right thing. So together, we're hopefully doing the right thing. So,
I think so.
and unless there are any more burning questions from the rest of the board, I'll let you go.
Thank you very
Thank you very
much. Have a lovely
much.
weekend, all. Speak to
You
you
are,
soon.
of course, welcome to stay, but I suspect you're busy enough that you might find something else to do.
Indeed. Well, thank you for the offer anyway. Thank you all. Bye now.
Thanks, David. Bye. But that was really useful, I think. And so I am going to move us to the next item on our agenda, which is a review of the Pensions Committee papers. And bearing in mind the time, I'm going to ask Anton to fairly rapidly go through what was quite a long committee meeting. If you can you give us the bullet points?
I will try to be relatively succinct, and obviously I will stop at each section for questions, and at the appropriate time in a second I will pass over to Shirley or Rachel
Yes.
to do the admin side. So in terms of performance, and I will just slightly cover what I said at the last meeting, we are definitely in a sort of a period in markets where they're not going in any great direction very quickly. So you will get a quarter like this one where performance is quite good in absolute terms. Nearly 2%. Well, if you get that every quarter, that's 8% for a year. That's absolutely fine. But the following quarter or the following month, you tend to see markets go backwards. We're definitely seeing markets go backwards in the current quarter. In the quarter just finished. I forget that it's just finished. The benchmark return for the fund is negative for that quarter. Not massively, but it is negative. And I don't have the fund actual returns yet because it takes us a lot longer than 6 days to work them out. So let me just get that number in front of me. Actually, no, it broke even on a benchmark basis. The quarter to September, it was up 20 basis or 0.3%. So
Okay.
The first 2 months looked like we might do better than that, but I'll say nothing more. So that's the only thing I will pick up there. Other than to say also, we are behind on the actuaries'
Yes.
projection. They said 4.9%.
Yes.
We then instantly had sort of the impacts of the Russian invasion of Ukraine,
Yes.
and inflation taking off, etc., etc. So we're behind that. I'm not convinced that the market is in a position that we are likely to make up the difference, but we probably won't slip back further.
Okay.
Um,
Okay.
And much to my depression, we are halfway through that
Yes.
cycle now.
Yes.
Literally, you know,
It's
last-
relentless.
last Saturday was halfway through the actuarial cycle.
Yes.
So unless there's any questions on performance, I'm going to.
But just one question on that. So the impact on employers within the Somerset Fund means that their contribution to make up the deficit is likely to go up the next time we request that. Is that correct? Is that the upshot?
The investment return impact of that is negative.
Right. Yes.
There are then obviously a number of other factors
Yes.
involved in those calculations, which may or may not be positive or negative. The overall, so the actuary provides a quarterly update, which I include in the committee papers, and I'm trying to find it now in that pack. If you've got that pack open, it's on page 41. And you can see that the overall level of funding has reduced from 95.2% to 91.1%.
Yes.
That doesn't include certain things, but does include other things. So it includes the impact of the inflation.
Yes.
It includes the impact of lesser investment returns. It doesn't have any impact for changes in mortality experience.
Because there was a big change in mortality because of COVID.
No.
Oh, okay.
There was a change in mortality between the 2019 and 22 valuations, in that the experience was that the rate of improvement in mortality was not as good as expected.
Yes.
It is possible, but not clear, that some of that might be related to COVID. The general wisdom with COVID and mortality is that, largely speaking, it brought forward, in a quite short mechanism, deaths that were quite likely to happen. So people that were ill and vulnerable,
Yes.
generally,
Died 6
and
months ahead of time. Yes.
might have died in the next 2 years.
Yes.
Died in that 6 month window.
Yes.
But mortality, like many things in pensions, it takes a while to find out.
Yes.
And so some would say the jury's still out on
Yes.
mortality in terms of COVID's long-term impact. And actually, yeah, COVID's still around. I was reading some really fascinating stuff about COVID yesterday, about a doctor in a scientist in America that studies sewage and could pinpoint one individual continuing to be infected, but not necessarily infectious, for 6 months continuously, and they could pinpoint them to the building they worked in, which was
I don't want that job.
it's quite bizarre.
Yes, yeah,
So, but it is a hugely
Yeah.
involving
yeah.
section.
Thank you. So shall we go to agenda item 7 on the committee papers, which is their review of our administration performance. So shall we go to Rachel?
It's
Oh,
you're
it's
coming
Shirley.
to
Shirley, hi.
Hi. Oh, I didn't like that of you then. It's me looking at myself. Thank you. So I will just give you a quick overview of the administration report. So the report itself focused on the performance of Peninsula pensions for the quarter ending the 30th of June 2023. And Appendix 1 shows details of types of work undertaken by the team and confirms the disclosure regulation timescales were met in 91% of overall cases, with 93% of cases for the high priorities. It's also included in a graph which shows the monthly trends analysis on the percentage of high, medium and low priority cases completed within the timescales since April 2022. In the same quarter, the team received 15 compliments. So if I move then swiftly on to Appendix 2, the report there highlights the longer term performance of Peninsula Pensions for the Somerset Fund from July 2022 to the end of June 23. The bottom chart shows how many of the remaining tasks outstanding are awaiting information from either a member or an employer, and that's depicted in the light blue and is approximately 38% of the outstanding work. Appendix 3 of the report is highlighting the amount of work received over the previous 12-month rolling period compared to the same period in the previous year. And the chart shows a slight increase in demand, but I'm pleased to report that the team has also completed more cases in that period as well. We are developing this report further to drill down to the specific areas that this relates to, so we can make sure we're fully resourced in those areas. And that leads me nicely on to confirm that following a successful recruitment drive, we're now fully resourced and busy training the staff. And this has come at a good time with the McLeod regulations finally coming into place and live from the 1st of October. And just for your information, one of our technical and training officers is leading the McLeod project for ourselves and is working with DLUC as part of the statutory guidance working group. And these are people that support the drafting of the new guidance for all administrators in the LGPS. So that was a quick overview of the admission or administration performance. And Anton had kindly agreed that at this point I could also mention about a reporting tool that we've been developing alongside Devon Audit Partnership. But before I do that, is there any questions on the quick overview of the admin report I've just done?
I've just got one. On Wednesday, a few members of the committee and the board, we met to talk about engagement. And I understand you're working through your member engagement process. So how is that progressing?
So that's going quite well. I've been working on both. So we started looking at a comms policy separate to the admission. Oh, I can't get my words out. Admin strategy that we have. But when we were looking at other sort of strategies that are around and other comms policies that are around, they seem to tie the two together. So Rachel and I've made the decision to do that. And what we're actually going to be doing is we are having meetings with all our employers in November, 14th and 15th, with the 14th being at the Holiday Inn just off of Junction 25. And we will be launching a consultation with employers on the administration strategy. And the plan is, and we only mentioned this bit to Anton yesterday, is that we send copy of the draft administration strategy to Anton to disseminate amongst yourselves on like the boards and the committee, so you can see it ahead of that. The consultation will run hopefully for a couple of months, but in time to then go to the boards and the committees early in the new year. So hopefully we can actually get that then in place in April. And that will just confirm where we are with our comms. And you may well have seen, Anne, because I know you did last year, about the pension attention campaign with PLSA. I'm not sure about the candidate for the videos this year. A bit different from Big Zoo last year with it being Timmy Mallett. Yes, so that's there. So we're publicising that at the moment as well.
Yes, it's going to hit a certain demographic, which is probably different from Big Z, but there we go. Yes.
Yeah.
At least I remember Timmy Mallett. So yeah.
Yeah.
Say if Timmy Mallett's involved, I feel a certain amount of barrel scraping.
Yeah, and he's got,
don't minute that.
Yeah. If you just click on the video, Anton, you'll love it. But the next bit that I wanted to share with you actually also leads into the engagement side of things. So I'm just going to share my screen if that's okay as well. It's only a couple of bits if I make sure I get the right bit. Okay. Let me see whether I can. Sorry to keep you. It's away, isn't it? Sorry. That's not what that's not what I want to share. That's my words, isn't it? So stop presenting that. Sample. Okay, let's go back. Sorry. So this is basically, whilst I'm trying my best to get it on to share for you. There we go. It's basically an example of a dashboard that we've been working with the Devon Audit Partnership, and it's going to be an employer performance report that we want to share with both yourselves at the board and committee levels, and also individual performance with employers. So the actual reporting tool itself will consider performance from both, as I've mentioned, a fund and an individual employer level, and it will recognise trends. So we will be able to ensure that we've got the right resources depending on what's busy at different periods, and it will also allow employers to recognise similar things as well. It will enable us to assess training needs and consider amendments to our training documentation and guidance we give to employers. If we're getting the same queries coming through from the employers, it will be quite easy to see that within this report, and it will hopefully also show us how engaged the employers are, because we'll also be including information of who attends different training events that we're wanting to put on, and also the readership of our online Easing the Pensions line, which is our main sort of source of information. So we're hoping these reports will be live from April 2024, in line with what the admin strategy, because we think they work well to improve the workflow across both ourselves and employers for the benefit of the members. And what we will do is, if I allow you to see what we've got here. So this is just like the opening page, and just really for like our internal staff in pensions to see and decide which reports they want to run, basically. So it's just been prettified. And then we move on to what will be the main page for the employers or for the fund, where we will do a description of the information that we've put in there, and we're linked to certain information such as the strategy, pension regulator, because there may be times where people aren't performing as well as they should be, and it's either whether we can help them improve that performance, or whether there's been a lack of engagement and we need to get assistance to move them forward. I should also say that it's not going to be called the pensions dashboard, because that will just confuse things with the national development, won't it? It would be really like employer report, something like that. That it will be nice and simple. So after that first introductory page, we'd move on to showing sort of starter information. So these is people that have started within the fund. It will show, this is done as a fund level, but it's only a sample of data, so not everything is, you know, a true reflection as such. It's just so that we can make the model work for us. So in this example, you'll see that we've split how many starters are being received each month. It looks like January was a very busy time, and then there's only like very few in December, which you would expect. But it's not that bad evenly, really. It's quite even for a few times of the year. But it also has got the gender sort of difference as well, which I know that people tell me that there are more females in local government, but this just put it quite plainly that there was. So that was interesting to myself.
Yeah.
Underneath the Somerset logo is information which relates to sort of the trends. So it's just saying that there were so many more sort of starters in one month than the other, and doing little comparisons like that. And we can alter that if we want to, depending what we want to put in there. So that was just on the starter information. And then we have similar for the leavers. Now, from our point of view, yes, we need to know all the starter information, but leavers are ones that we want to get the information out to them as quickly as possible. The disclosure regulations does allow us, you know, good time to actually generally give that information out to people when they leave, but it's for those that are retiring, it's sort of a continuation of their pay. So we do want to try and move things forward. And we think with this page, the employers will be able to see things a bit more clearly. So in this example, you'll see that on the pie chart, it has different types of leavers. So we can see which ones are leaving the fund with less than 2 years service. And that's just over 50% of them in this example. And how many are leaving under 55, so they're not entitled to immediate benefits, and then moving on to those that can access their benefits over the age of 55, and late retirements, etc. And those that have opted out, which is a very small percentage in this example. So that with having that will allow us to drill down to things a little bit more as we move forward and concentrate on if employers are doing things slightly late or why. And that brings me on to the bottom two sections. So the one which is on my left, which has the date of leaving, you'll see the top one says the 21st of August 19. And then if we move across to the process date, we didn't get the leavers notification until the 23rd of August 23. Now, the disclosure regulations state that for a late retirement, we're meant to get information out to that member within a month of their retirement date. So obviously, in this example, they're showing that days over of us receiving the data is over 1,400 days. Now, this is, as I say, an example of data. So this could be for any reason. We'd have to like look behind that and see whether it was an amendment to the original leavers form or what was happening there. But if you looked at that on face value, it's not looking very good, and it would be a reportable event. So it would be like classed as a breach and could lead to fines from the regulator. I would hope nobody would wait that long to get their benefits though, without shouting quite a lot beforehand. So, and then on the right hand side at the bottom, it's about what we would have there is the employers' names and also how many leavers that they've had within that year that we were maybe looking at, or period. In this example, it's a couple of years that we were looking at for this. But that's a whistle-stop tour of what we've got so far. So any questions?
That all looks really fantastic information, Shirley, and to present it like that, and I'm loving the pie charts and so on. Something that it sparks in my mind is again going back to our discussions that we were having on Wednesday about the board and the committee trying to come up with our engagement strategy, our communication strategy. And one of the concerns was that it would cause a spike in demand for you at Peninsula. And I just wonder if you have seen any spike in demand because of pay your pension some attention, and that will give us some indication of, does it increase engagement as it's supposed to? Does it cause the members to contact you?
I mean, Rachel may want to come in, but I haven't seen that here so far. Not with the pensions attention campaign. Now it may be that because we've although we've put it on our website, we've then pushed it out to the employers. So it's whether they then share it. And I don't think I've actually seen anything on national TV really pushing it at all. So that hasn't. But if you're actually sending communications out to the Somerset Fund, I would see that should hopefully have people coming to us. If it's more about the investment side of the fund in Brunel, I would see that going to Anton's area rather than ourselves. But yeah, that's how I would see it. I'm not sure if Rach would agree with what I've said. Oh. This is muted.
Doesn't want to, oh, hang on. There we go. Can you hear me now?
Yes.
Sorry about that. Yeah, I agree with what Shirley said. We haven't had any particular spike in communications either. The phone calls haven't jumped up, and we haven't had inquiries jumping up either. But equally, we do each year when the annual benefit statement goes out, we do have a link to our website, which then obviously has all the information on there. We have links on our member self-service as well, which takes back to the website. So we do what we can to get the members to engage. Not always easy, but yeah, we're sharing the information with them, but haven't seen any particular spikes because of it, no.
I don't know whether that's good or worrying, really.
I know.
Yeah. I think people just aren't, well, worldwide probably, people aren't engaged with their pension until the point where they're about to claim it, and then they start to think about it. But yeah.
We have got, I'll just mention one thing. We have got a new version of member self-service, a new development on it, which is coming in over the next month or so. And on there is a financial planner, which will give the members the option to actually put in outgoings or forecasted outgoings. So looking at mortgages, rent, insurances, what they're going to be paying out, and what their expected pension is estimated to be based on what they're currently paying. So when that goes live, obviously people can then actually see figures and think, oh my goodness, I'm quite a lot short here. So I'm hoping that will be used a lot, the planner, and we'll be highlighting it each year in the annual benefits statement, and it's a bit more visual then.
Yeah, Yeah.
And with-
I know our Rachel here has got a question for you, and then I'm going to go to Simon, but I'm going to jump in. I'm going to use the chair's prerogative and jump in ahead of both of those. And I know, Shirley, you mentioned that you're not going to call yours the pension dashboard because there's going to be this nationwide pension dashboard. So how are Peninsula moving towards that? And do you have any deadlines that you can give us about the national pension dashboards that's going to be with us at some point?
I can pick that one up if you like, Cheryl.
Yep, that's fine.
Sorry, Cheryl. I said to Shirley, I'll keep my mouth shut. I'm not doing very well, am I? So yeah, with the National Pension Dashboard, we've had discussions with Hayward's, regular discussions with Hayward's, our administration software providers. They are actually key with working with the money and pension service with MAPS in introducing the dashboard. They've been one of the key sort of involvements. So it's been quite handy for us to have them. What they're actually going to do is in January, they're going to come to our office again. They've given me lots of figures, lots of information to process on, because obviously this isn't a cheap development to be able to get this secure connection between our system and the national dashboard. So we're going to go through that in January. So for the next committee and board, we should have some more data, some more information. But yeah, there was talk of, although the official date was had been pushed back, there was talk of 2025 potentially being the date, but it's nothing affirmed yet.
I can also say that at the November employer meetings, we've got a representative from MAPS come in as well, and we'll talk about the dashboards there. So that will hopefully be interesting and give us a bit more information as well.
Thank you. Right, I'm going to go to our Rachel now, who I know has a question.
Rachel, just a couple of questions from me, please. First one.
Sorry.
Oh.
Morning, Shirley. Morning, Rachel.
Morning.
Hello.
Just a couple of questions from me, please. Are we going to be able to influence the dashboard that you're building?
Yes, so
Go, Cheryl. I'm going to zip.
so the dashboard part that I've just shared, then the employer performance report, we're going to show that at the November meetings, and we're going to have the data analyst who's created it there as well, with actually saying what you've just said, to hopefully, if where you've got questions or think there may be something good to be added to it, that they can see if they can incorporate that before it goes live.
Because I do think some of those statistics where you pointed out the 1400 days is meaningless with nothing behind it, you know.
Yeah. So
is
that
it because the estate didn't engage with you? Is it because we as the employer didn't do something? You know, what has happened? That to me is alarming for people who don't understand what could sit behind that, but gives me, as somebody in my day job, nothing to, and because I'm not aware that we're being asked for something that's 40 days old. Let me put it that way. So
yeah,
I find that quite meaningless. Just alarming for other people who.
I think, you know, there are cases that we've done a report recently where we've been trying to engage with different employers, and they've got, I would say it's the odd lever, but odd levers going back to that time where they haven't provided us with information. But obviously, when we came to the individual reports, we would be looking at that and seeing what is behind it as well, rather than just show it like that. So
yeah, and which employer it is, I suppose, is really important.
Yes, it would be.
Isn't it?
Yes, yeah.
The other thing from me is I think we've asked before for a little bit more detail on the complaints. When do we get that? Is it only once a year or in your administration report?
So you meant like a breakdown of the type of complaints that it is, whether it's like informal or formal complaints. Yeah.
And a brief summary of what it is. So
yeah.
is the complaint upheld by you, or is it something that, you know, you completely disagree with? I don't know. That sort of thing was what I was expecting to see. I think we talked about it
Couple of meetings ago,
a good
at least,
couple of
yeah.
meetings ago. I think Rachel was there, not you, Shirley, but yeah, and I was expecting to see something this time round.
Yeah, we can arrange that, and you're right, you have said that we haven't got that together yet. The complaints are included in the annual report, and they are broken down into those that are related to ill health, because a lot of them go to, with if there's an ill health and there's an IDLP, a lot of them, a percentage of them are those, and then admin ones. But if you want it drilled down a bit more than that on complaints, we can have a look at that and see the best way. So yes, we can pick that up, and that's up to you. If you would like that quarterly, we can arrange that quarterly. If you want it annually, we can do it annually. Happy either way.
What would you like, Rachel? Go on, ask for it.
Well, I'd like to see it quarter. I'd like to see it next time.
Quarterly.
Not, you know, if there's an administration problem, we
Yeah.
should be looking at. I'm sure it isn't, but you know what I mean. We should be looking at it as quickly as possible.
Yep, that's no
Okay.
problem. We can get that
my,
added.
my final thing is just for my colleagues really. As Somerset Council, I obviously can't speak for other employers in the fund. We do quite a lot of engagement with employees within Somerset Council on the AVC scheme.
Yes.
And our AVC shared cost AVC provider, so shared costs are ones where you save not just tax, but you save national insurance as well. A company called AVC Wise do an awful lot of webinars and engagement sessions that staff can join. And we've certainly seen a spike in AVC
Yeah.
use, and part of that is understanding your pension scheme.
Yes.
So I can't tell you here how many people have joined them from Somerset Council, but what I can say is that engagement they tell us is quite good. I could ask for some statistics which would support our engagement plan.
I think that might be useful for those of us, and I know Mick Dunk's on the call as well. When we were talking on Wednesday, we were trying to find a way that would get people engaged, and you know, something like additional training, additional webinars and things like that at no cost to us as a pension fund. That would be useful, I think.
They do some really good, obviously
Yeah.
their purpose is for people to increase their pension by
Yes.
taking out ABC
Yes.
through them, because
Yes.
we pay them an admin fee
Yes.
for it, which is based on our employer national insurance
Yes.
savings. So we save 13.8%. We pay them 4.5% in as that, and as the
Yeah.
employer, we can keep the rest.
Yes.
Obviously, we've got a comms person who supports the
Yes.
communications and whatever, not solely for that. But yeah, but I think that might be something that when we get to engagement, we really need to involve them
Yes.
heavily as well.
Yes. Thank you for that, Rachel. Simon.
Yes, okay. Anecdotally, I have to say that the system has not worked in a couple of cases. The letter giving the information, connection information didn't arrive. The first one didn't arrive at all. The second one arrived on the last day of it. And then the individual could not get the information that they were looking for. So there's there is a disconnect there somewhere, and I'm not quite sure where the disconnect is.
Is this in the
One.
self-serve?
Signing up.
Yeah.
On the self-serve side of it, has not worked at all. And then because there was a time scale, and I can't remember if it was 7 days or 14 days, but the letter arrived on the last day, and because they had applied previously, that one was disregarded, and the next one ran out before it arrived. So there's been some disconnections there of the system not actually working.
So it's almost like
And it was-
two-factor
it was-
authentication.
yeah.
So the authentication has to come through the post, and then there's delays in the post,
Yeah.
and then they've run out
Yeah,
of the
They've run out of
deadline.
They ran
Okay.
out of the deadline time. Also, the queries were about ABCs.
Okay.
So it was it was somebody trying to actively engage
Yes.
and not being able to engage.
Yes. Okay.
And when they phoned somebody, they were told they couldn't be given advice over the phone. When they were
Okay.
seeking advice, they wanted to get into the record
Yes.
system,
Yeah,
which is not the same thing.
which must be intensely frustrating
It
for them.
was-
Yeah,
As I understand, it was intensely frustrating.
yes, yes.
So I'll just throw that in there anecdotally.
So Shirley, what can we do about delays in the post that cause members frustration in trying to, so with that authentication information having to come in some sort of secure manner, so having to come through the post, but then there being delays in the post, and then that means that they can't sign up for member self-serve. That must be frustrating.
So, and it was a member that wanted to sign up is what we're saying, because
Yeah,
I was just trying to work out the connection with the AVC. I think it's difficult to see without that, knowing that member specifically. But the new TME, as we're calling it, but which is classed as the member experience, but will be known still as member self-service when it's out there officially, has got a different authentication as well. I can't remember, I'm not sure if Rachel can, whether in my head, I think we were trying to get it so that it would go out via email rather than via post, but I'm not sure that it can in all cases. So we can come back on that unless Rachel can remember that part. Not sure.
but in that particular member's case,
Yeah.
could that member contact someone directly, because it sounds like they had a frustrating experience, and we need to go back on that and try and fix that.
Because we have a team on when they phone, which deals with member self-service queries and the signing up of people onto the records. They may still need to make sure it's the right person, so may need to send that letter out, but it's just making sure that we've got the correct address. It sounds like we have, but then there was a delay with the post, which I mean, we would have sent it out as soon as we could at our end. So it's reliant on the post as well. So,
Yeah.
but yeah, by all means, get the member to contact us. If they can't get through to somebody like within the team, if they're not satisfied, then they can contact myself as well, and I can look into it. There's Rachel arrived again.
Yeah, I think you've answered it, Cheryl. All I was going to add is that just for information, we are very aware that we want more focus on the support that we give members. So in January, we're actually having a member support focused team that will deal purely with phone calls and with general inquiries through the member self-service portal. And that will be their key focus, as opposed to at the minute we have phone calls across the office with people doing calculations and answering the phone as and when. We will have a specific member support team, and that's going to be in place in January. So this again is trying to help with member engagement and the service that they're given. So we're expecting that to help.
Thank you. That sounds good. So
I will advise the member to
Yeah.
recontact, because
Yes.
they were told on the phone that they were not allowed to talk to somebody. They had to do it all via
okay.
via the
Well, and if they
system.
if
So
they don't get
there was
progress,
some frustration.
I can imagine. I can only imagine. And if they don't get progress, Shirley's offered her contact details directly, so that's a good way forward. Any other questions from the room for either Shirley or Rachel, if she wants to jump in? Any more questions on an admin front? I don't think so. So thank you very much. And again, I'll let you go. See you in a quarter's time.
Take care.
Have a
Bye.
good Christmas. Okay.
Bye.
You're wishing away at you away.
I know. Fantastic.
Shall I crack on?
Yes, please do.
So the next
Yes.
thing was the committee's business plan. Just a couple of things I'll mention here that were raised under this item. The government have laid regulations on the McLeod remedy. So in terms of sort of regulatory move forward, that is I think, just about done now. And it's just now Peninsula's nightmare to implement that, along with Hayward's. The audit of the 22-23 accounts for the fund is finished. The audit committee of the council received the audit findings report. If anyone wants to see that, it is in their the papers, or you can just ping me an email and I'll ping it on to you. They didn't find very much.
Okay, good. That's good news, always. We want a clean bill of health.
Yeah, they won't officially produce their audit opinion until they close the county council's accounts, which might not be until January or sometime such. So we won't get the official opinion until then, but it probably will be a unqualified audit opinion. The only other thing that came up under this, I say the only, because it was a significant item, was the consultation that was open with government on the next steps for investment, as they euphemistically phrased it. I have bombarded you all with emails on this. We did have to put in, well, if we chose to put in a response to the consultation, it had to be in by Monday.
Yeah.
And I put one in, and as I say, I've circulated that with you on email, but I'm happy to take any questions on that before I move on to the next paper.
So that was about almost trying to compel us to invest 5% of our pension funds locally, and what locally meant was UK wide. I think
the phrase is towards levelling up.
Leveling up. Well, we see how much let's not get political. Let's move on. Yeah, HS2 and so on.
Yes. Anyway.
Yes.
So then the next paper was the finance and membership statistics update, where we reported the normal membership statistics. I think the only thing I noted there is, for the first time, the number of pensioners has outstripped the number of active members.
Oh wow.
There's nothing
Yes.
particularly seismic about that, other than it is
It's
a crossing of the Rubicon,
Yes.
but it doesn't in
Yeah.
itself have massive implications. And it was, given long-term trends, it was inevitable we would get there.
Yeah,
But this seems
but
to be
we have got there.
we have got there. And then there was the outturn for the 22-23 year against the budget,
Yes.
which was surprisingly in line from my point of view.
Well, that's good.
So there were a few bits of sort of bit over, bit under, but nothing particularly to comment on. And we should have provided the Q1 outturn on the 23-24 year, but with the new finance system being in, we're having some slight issues getting
Okay.
information into that and then
Okay.
out of it,
Yeah.
which I remain confident that will be sorted by the next quarter. And I'm not sure if my confidence is well based or not, but I'll say
Let's be
I'm
optimistic.
confident.
Yes.
So any questions on that? We then had the risk register.
Yep.
And there was no particular discussion around that, and it's on our agenda, so I'll pick anything
Yes.
up under our agenda. There was then policies and statements, where we looked at the funding strategy statement post the employer's consultation. And there was a discussion around that. We did have one specific response, which I circulate. I'm pretty
Yes.
sure I included.
Yes.
I did include you on the circulation
Yes.
of. And then, but ultimately, that was approved by the committee.
Yes.
And then we had the annual report, which is a document of much joy and happiness for me.
And makes up the bulk of the papers that I have in front of me.
Yes. And again, that was approved by the committee, subject to the addition of the auditors.
Yes.
Formal opinions as and when they might issue them at some point in the future, maybe. Hopefully. I shouldn't moan. At Somerset County Council, we've been very lucky that at least the opinion has been issued by the auditors each year within the following year. Many councils that I speak to are through Brunel, and a couple of our districts are 2 years behind.
Wow.
With the audit being signed off. So I shouldn't moan, but it still feels really a long time to sign off an audit.
Yeah.
I'm quite happy to take any questions coming out of the morass that is the annual report.
I think my only question is, it is an enormous document, and I wonder who reads it, who consumes it. You've read it, okay? I have read it in the past. I haven't read it yet. This time round, I did when I was young and keen.
I suppose there's a so in terms of its length, the only thing that I could do to significantly reduce the length is we are not required to include all of the policies and statements in it. But I think it is much better to do so, because then it is a one-stop shop
Yes,
for those. Because actually, whilst we are required under the regulations to publish the investment strategy statement, we aren't under the regulations required to publish any of the others. Now, they're all included within the committee papers of the meeting that signs them off, but it's a useful one-stop shop. And actually,
yes.
for committee members,
yes,
when you read through it, by definition, because you have read those, because you must have, because you signed them off.
yes. It should just be a refresher.
Well,
shouldn't it?
you
Yes.
could just skip that section.
Can I answer a plea at this point, Anton, that you continue to do that? Because if it just becomes a link in the papers, I wonder whether at 3 a.m. when I'm reading the damn thing, I'm going to bother with the link.
Yes.
In honesty. So
Yeah.
I know it's a tone. I know it's a.
But
It's not
as
a riveting
Anton
read.
says,
I apologise for that, Anton, but it's not a riveting read.
No.
And if I've got to start looking,
Right.
and if I've got to start looking elsewhere for some of the information, I suspect I won't do.
yeah,
that.
I mean,
in honesty.
it is all there. We can think of it as the Encyclopedia Britannica of our workings. And if you want to find some information, it's in the annual report. It's elsewhere too, but it is in the annual report. So
And as I say, pretty much everything else is required by the regulation. I mean, there's some things that aren't. So there's a brief section just saying what are the funds we're invested in Brunel, and saying who the underlying fund managers are and what the benchmark is. But that's 2 pages, and it's again, it's in the committee papers, but it's useful to have it here.
it is. It is. Yeah.
I also I'm bound to say, with much disappointment, it will get longer. Because as and when the government actually gets around to telling us what we need to do under TCFD, the Task Force for Climate-Related Financial Disclosure, there will be some pages on that in there. And depending how the government reacts to the consultation they've just had, they want us to include various other information in our. I mean, the government's answer typically is, "And please include more information in your annual report." And CIPFA,
They never say less.
and CIPFA and the Scheme Administration Board tend to chip in with the odd extra thing as well from time to time. So it is just going to keep getting longer. I can show you the first ones I did. They were much shorter.
Apologies, Chair. I have another meeting.
No, quite. I am hoping that we will be finished shortly.
And then the last item on the committee agenda was the knowledge and skills.
Yes.
One thing that's going to come out of that is that our actuary has made available to us a learning portal.
Okay.
And so I'm going to make it available to you.
Fantastic.
So, because what the survey we did showed was that there were no specific areas where those that completed the survey were across the board hideous. There was nothing that said this is the area we must concentrate
Okay, so
on.
there's no enormous gap.
There's no specific area.
Yes,
But there's a little bit of gap everywhere.
everywhere. Yes, I would imagine that was, yes, the case.
And
Yes.
so at the moment, there's not a massive amount of content on the Barnet Waddingham portal, but they will be adding to it. So that seemed like a low effort way to give you something to
Yeah.
engage with in a generalist sense, that you can do in your own time.
Yep.
Assuming you're willing to sit online and do it. And I will once a year go to them and say, so who's done what?
Yes.
And how did they get on?
Yes.
So I can add that to the report in the annual report.
Yes.
So I will be providing your email details to Barnet Waddingham shortly, and you may well get some sort of email contact from them confirming that you have been set up.
Okay.
And then we'll go from there. I suppose I should also mention in that context that as with most contracts, we have to periodically go to tender, and we are currently about to launch a tender for the actuary contract. And we're doing that with Devon because the last thing we need is for Peninsula Pensions to have to deal with two actuaries.
Yeah.
Because that would just be a waste of resources
Yes.
and drive them up the wall.
Yes.
So we've agreed to procure with Devon, and we will, although it will be two separate contracts, we will appoint the same.
Yes, that seems sensible. That seems very sensible.
And that will, the plan is that, so our current contract goes to the 1st of April, and so the plan, and so does Devon's, and the plan is to have a new contract in place for the 1st of April.
Great.
Unless there's any questions on that, then we're done with the committee papers and we're back to the board's agenda.
Which is a look at the risk register. Are there any changes to the risk register?
Not since your changes earlier in the year. And it's sort of probably in my inbox for next week to bombard you with an email to request some sort of indications of when you might be free, along with committee, to have an informal session on the risk register as promised. And I've also been contacting my brethren within Brunel to gather their risk registers so that we can use that as a, is there anything we're not thinking about sort of check. I will try and précis them down because some of them aren't quite as succinct as ours.
But that's great, and hopefully some of us and some of the
many
committee will be available to have a meeting about the risk register. Great, good. So I think the last, other than the AOB item, the last item on our agenda is our business plan update.
I have to say, I thought we had something else agreed that we were going to talk about on the business plan, but I couldn't find it. So,
No, I think we've had a really good meeting, so
Yeah.
I'm not worried.
And
Yeah.
the admin strategy will be coming. It's not on the papers because I wasn't aware it was going to be available at your next meeting, but the admin strategy will be available at your next meeting. So that will be an item of
A meaty item for us to talk about next
Yes.
meeting. See you next time, Sigurd, I hope. See you, bye. So how is our business? We've got things upcoming in our business plan. We've got the admin strategy, hopefully next meeting. Is there a anything
Well,
more
it-
meaty to come up?
It may well then precipitate the comms strategy the following meeting.
Yes.
We'll see how that sort of
Yes, it's
evolves,
progressing.
but that seems like the most likely sort of
Yeah.
direction of travel.
Is there any item that any board member would like to bring up in any of our future meetings? keep thinking, and if something occurs, either let me or Anton know, and we'll put it into an upcoming meeting. And unless there are any other urgent items to be discussed, I think I will call the meeting to a close at only 2 minutes past midday. Thank you very much. See you after Christmas.